Welcome back to Fast Money. Stocks heading into the fourth quarter with momentum. The S&P and Dow both posting record closes today. The Nasdaq just 2% off from its all-time high. For the quarter, the Dow was up more than 8%. The S&P and Nasdaq both up 4 quarters in a row. Meantime, the benchmark 10-year Treasury yield dropped about 60 basis points during the quarter. Today, Fed Chief Powell indicating the central bank would cut its target rate further, but in smaller increments than maybe the market is pricing in. Our next guest worries the Fed could go too far still. Let's bring in Wall Street forecaster Jim Bianco, Bianco Research. Jim, great to see you in person. Go too far in what way? Because today, the baseline that he laid out seemed to indicate 25 basis points at the next 2 meetings.
Yes, you're right. He used the magic words over time, which meant don't expect another 50 basis point cut right away. Maybe we'll do 25 and 25. I fear he's going to go too far in that I'm in the no landing camp, that I think the economy's okay. He kind of said that too. He talked about normalizing interest rates. The market thinks that's cut them all the way down to the low threes, that might be too much, and that we might stimulate too much, and we might see a resurgence of inflation, and that we're going to go too far the other way.
So we were talking earlier about the port shutdown and what this could mean for inflation, right? So we could see a spike in inflation. Do you think that weighs on his comments at all? And does that matter for policy?
Well, the port shutdown is going to be complicated for the Fed in a lot of different ways. You're right. One, if we see that shutdown last for any significant period of time, let's call it more than 3 days, especially if it's more than a week, you're going to see shortages. You're going to see shortages in stores. You're going to see higher prices. If it lasts more than a week, you're going to see a lot of people getting laid off. And there is an argument to be made between the port shutdown and the hurricane. You could be looking at a negative payroll report for October into November, 5 days before the election. There's still a lot of moving parts with that as well. This would just completely complicate everything that the Fed is trying to do because they're not getting a good read as to what the economy is actually performing.
What are your takes on the re-steepening of the yield curve? The historic in terms of the amount of time that was basically inverted, the speed with which we've gotten to, 20 basis points or so is interesting. What does it mean, if anything?
Well, you're right that the yield curve had been the longest that it had been inverted. And I think the takeaway from that was interest rates were not that punishing. I know the Fed talked about that they were restrictive and that they were dragging the economy. From the last rate hike to the first rate cut, last rate hike August 23 to the first rate cut 2 weeks ago, the S&P was up 23%. So it didn't seem to bother the stock market that we were stuck at 5% interest rates. The re-steepening of the rates, I think, is somewhat of a bearish signal. Bearish in that the front end of the yield curve at around 365 in the 2-year note is essentially pricing in the entire move. So if the Fed does cut rates 200 basis points, what should the 2-year note do? Nothing, because it's already priced it all in. What should the back end of the yield curve do? That's where mortgage rates are set with the 10-year yield. They should rise if we continue to see a steepening. So a steepening at this time and at this setup is probably a bearish call on interest rates.
Let's say the port strike in the hurricane muddies the data that comes in. Do you think the Fed would be more inclined to err to the side of waiting and just stepping back and saying we're not going to, we're going to proceed with what we planned, or err in the way of going too far?
I think they'd probably slow down. I don't think that the Fed wants to be viewed, especially when it comes to the inflation story. Let's remember May of 2022 was the only meeting President Biden had with Chair Powell, and he literally pointed at him and said, America, this is a guy who's going to get rid of inflation. And if you have that optic, because the Fed is political, of a big inflation number, and then they decide that they're going to ignore that and start cutting rates aggressively in the face of that, that could be not a good optic for the Fed. So I think they'd probably go 25 until they see the data settle out once we got past it.
Okay. Jim, great to see you. Thank you for stopping by. Jim Bianco, Bianco Research. I mean, it sounds almost like